You're listening to the RE Social Podcast with your hosts, Andrew and Vince from AnVi Invest. For more information, go to anviinvest.com.
What's up, you guys? Welcome to another episode of RE Social Podcast. Today, we have Joe Brady, and I'm very excited about this conversation because usually, you talk to single-family home guys, who have duplexes and triplexes. Joe is not that. He has a bunch of retail. Welcome to the show, Joe.
Thanks, Vince. Thanks for having me.
Yeah, thanks for taking a late call from Jacksonville. You're just south of my sister who lives in Atlanta, Georgia. I know you're 3 hours ahead. Now, for people who don't know you, Joe, I know you wrote a book recently, Workshop, and you're talking about technologies and commercial real estate. Can you give a little 90-second intro about yourself to the audience?
Sure. Yeah, happy to. I've been in commercial real estate for about 35 years, and most of that has been in and around the retail sector. I had a business I sold to JLL, where I started the retail practice at JLL with the team, went on to become head of real estate at Walgreens, and led the Walgreens portfolio, 9,000 stores, 150 million square feet. And then during the pandemic, I worked for a company that was based in London. I ran the Americas, and it was essentially the Airbnb of flexible office space. So I really had a front row seat during the pandemic as office was going through a dramatic tectonic shift.
Oh, nice, man. I'm writing notes as you speak. There's already like five different things I want to go with, but I'll start with Walgreens and real estate. You're kind of managing the real estate of Walgreens. To my understanding, I'm assuming Walgreens does not buy real estate and they just lease. Is that accurate?
When I arrived, Walgreens owned somewhere around 15 to 16% of the portfolio, which was a little bit over $10 billion worth of real estate. So historically, preferred developers would go and build the stores, but Walgreens caught on to the fact that they were creating a tremendous amount of value with that triple net lease. And so they changed the program a bit and started keeping a number of development deals. So the company wound up amassing a pretty sizable position of owned assets. Those have since a majority have been sold off in sale leaseback fashion. But you're right. Right now, it's predominantly a leased portfolio.
And these properties, if you're a landlord and you're listening to the show, they usually trade, you would say, sub 5% cap rate because of their triple net?
It depends on where and how much term is left. But, you could see occasionally sub fives, but, 5 to 6, 6.5, depending upon the geography and how much term.
Mm-hmm. And then they put in clauses to increase rent every year, or no, it's just fixed for 10, 15 years for the term.
The original leases were 10, 12 years fixed. There would be some bumps in the 5-year options thereafter, but by and large, Walgreens really wielded their influence and power and got pretty good deals.
Okay, man, that's cool. And then my question is, in this show we usually talk about the personal journey too. I see that you've done a lot of stuff working for someone else. I want to know where along your story you figured out, it might be a good time to buy assets and own it for myself while these guys are all printing trillions of dollars and giving it away. So I want to know about that story. Did you start on day one? You're like, Walgreens is buying, I'm buying too. Then, like, how did that work?
Even before, Vince, I would say in my mid-early 20s, I started buying real estate. I was a Burger King franchisee way back when, and found that buying dirt, building buildings was much more preferable than to actually running the stores and dealing with operations. So I kind of learned early on that I wanted to own real estate, and all along my path, whether I was doing something entrepreneurial, building a company and then selling it to a bigger company, I was always developing and investing in retail real estate along the way. So whether it was a single tenant Starbucks deal or a multi-tenant 24,000 square foot little strip center, I was always investing and always putting money to work in addition to whatever day job I was doing.
So how did you figure that out, Joe? Because that's like a big thing. You're just like casually like, yeah, of course. I started buying Burger King joints. Like nobody does that. So how did you figure out that this is something, there's trading time for money. I still do that. I work for W-2, a good company, but it is what it is. I'm not getting equity in the company. So how did you figure out, hey, this trading time for money is only going to take me so far, so I got to take this paper and then park it in like a Burger King building? How did you
well,
figure that out?
yeah, I was working for Burger King Corporation,
Okay.
and I met a franchisee through a fairly complicated deal,
Mm-hmm.
and we started negotiating and talking, and I wound up partnering with him. So I was able to get an inside track, which really isn't open to uh, the public necessarily. So I was fortunate in that experience. The partnership lasted for about 4.5 years, and then I wound up selling my share back to him. So I call that my burger bucks, right? I had just a little pile of cash, and then I started using that to roll into different build-to-suits, and I always found that uh, it was best to partner with people I liked and trusted, and who had complementary skills to mine. And so, I'm looking back at all my investments. I haven't done one that was just solo. So I've always had partnerships, and really focused on making sure I had the right partners doing what I was doing.
Yeah, man, that's really key. That's a good point. Having partnerships and having different people in the deal. I always enjoyed that too. Now that I was thinking, I only have a 6-year career in investing, and I've never done a deal by myself. I'm always involving either my buddy Drew or my sister, or somebody's mom, or it's more fun. That's
Yeah.
I always like that. So that's cool, man. So you got into, so you have looks like you have two careers. You have a day job, and then you're dabbling in Burger King, and then you got involved, and you made some money. So that money you're now taking to buy more. You're going where the people are running businesses, and you're buying the dirt. Is that what you're doing?
Yeah, well, actually, kind of pivoted to the single tenant net lease deal. So the
Sure.
first deal was a little wireless operator that was based in Chicago, that then we built and sold, and then we rolled that into a bank deal, and then sold that. And again, leveraging the 1031. And it was nice because I had, like you said, I had a day job doing a number of different things. Plus, I had these investments, so I didn't necessarily need to take my chips off the table. I could keep rolling and leveraging, and so that worked pretty well.
Yeah, that's awesome, man. That's cool. So you got the wireless operator, and then while you were doing this, you were saying, before we started recording, that you were starting to see some discrepancies or like outdated technologies in how the real estate deals are done commercially.
Yeah, and what I would say, sort of flash forward, looking at the retail industry in particular, so much changed when the iPhone emerged in 2007. And what we saw for retailers was consumers now had this power in their hands, right? So they were, if you remember, in the early days of e-commerce and omni-channel retail, everyone thought no one's ever going to go into a brick and mortar store again. Everyone's just going to sit at home, and then everything's going to get delivered, and the whole retail industry is going to crater. Well, we had horrible clickbait along those lines, and the reality is that didn't happen, but the consumer did gain primacy and really voted with their wallets as to which retailers were relevant and which ones weren't, which malls and retail locations were relevant, which ones were not. And that had a pretty profound effect. I mean, in the last 10 years, there's been over 100 million square feet of retail space taken out of the supply side of the equation. You think about Sears boxes or JCPenney boxes or some of these old outdated malls that have been...
Remember Circuit City?
Circuit City, right? I mean, that box got empty. And then nowadays, you're still seeing it quite a bit, right? Big Lots just filed 99 cent only out by you. They went dark. But then they get backfilled by kind of the more relevant, the hip, the happening retail concept.
Yeah, that's cool. So very interesting. So I like to keep a timeline, with your stuff. So were you still doing the first job that you had while you were picking up like the second and third deals?
I wound up working after the Burger King gig. I wound up working for Hollywood Video. Talk about a company in an industry that doesn't exist anymore, right?
I know Hollywood Video.
Yeah, right.
Yeah.
So I was part of the team that rolled out probably the first 2,000 stores. And so I joined the company at about 100 stores. And by the year 2000, we had built almost that many stores. And then the music stopped. So while we were working the day job and rolling out video rental stores around the country, we're still looking at and investing in deals. And it was quite interesting. By the time 2000 came around, I wound up starting another entrepreneurial company called the Standard Group with 3 other partners. And we were positioned as an outsourced retail real estate department. So retailers or clients would hire us, and we would help them with their strategy, with their revenue forecasting. And then we had a whole network of brokers around the country such that we would act as the directors of real estate. We would find a deal, get it approved, we'd negotiate the lease and help get it open. So while we were doing that, we also started collectively developing. We would be out and about looking on behalf of a client and see a piece of dirt, go ahead, tie that up. And we wound up doing quite a bit of development during that time as well.
Nice. So, in this show, we take a deal, any deal of your choice. It could be your first or your last, and then we break down the numbers. So can you give us maybe the first deal you might not remember? Do you want to give us the last deal that you did and then what the numbers were? Like, so I'll ask you some questions. So like, what was the purchase price of that last deal you did?
Let's see.
Or any deal you want to talk about.
Yeah. I would say I'm working on a deal right now. Okay. Purchase price, the dirt's going to be about $2 million. Okay. 20,000 square foot box. And rent's going to be about $30 a square foot in the automotive business. So we're...
Or is that 60,000?
I'm sorry?
Is that what is that? 6,000?
600,000 a year in rent.
So 50,000 a month, right?
Yeah.
Okay.
And then you're in California, everything's by the month, right?
Yeah. I know you're thinking, bro, you said to cap rate, what are you doing per month? Like, oh, sorry. Okay, so you got 50K a month, 600K a year, and that's the rents projected, or you like you're gonna get it because it's a big box guy?
Yeah, that's the rent contract. That'll be the contractual rent.
So since this is triple net, like, is that like, can you take that as, you can't take that as net, right? What would you do for net?
No, it'll be a complete triple net lease. So the tenant's going to pay everything.
Taxes too.
Yeah, absolutely.
So that 600K is coming to your pocket.
Well, yes, and our intention is going to be to turn it and sell it, and we think the market right now is probably for this asset and where it is probably at about a 6.5 cap.
Uh-huh.
Uh, so we'll build at an 8 cap and sell at about a 6.5 cap. So 150 basis points. It'll be just a little bit under. Be about 18% margin, and we'll have a small development fee in there, so should be a solid deal.
So if you do 600,000 divided by 0.065, I'm getting like 9 million, but you won't be able to sell it for 9 million, would you? You bought it for 2.
No, the dirt was 2, and then
what's the cost to build everything?
The building, I would say about $230 a square foot.
So times 20,000.
Yeah, so it's going to be
4.6. So you're in for 6.6, and plus, you can get 9.
Yeah, no, but there'll probably be there's additional cost.
Yeah.
But I mean, it should be a good deal. And we're talking here on the 17th of September, and hopefully we're going to hear some good news from the Fed tomorrow on the 18th, which will further bolster cap rates and really spur some more investment in energy into developing.
Yeah, what kind of debt we talking for the 2 million? Is you putting in cash, or you bringing in partners doing cash, and then you're going to borrow the remaining 5-6 million?
Yeah, well, we'll probably finance it. We'll put 30% cash in and finance 70. We've been pretty conservative recently, maybe 35% cash and 65%. So it just depends on the lender. I'll tell you that there are for the high rollout credit tenants, there's quite a bit of programmatic money out there. There's some funds that will literally fund the whole thing with equity and provide a takeout for us at the end, which is interesting. And so we're looking at lots of different options on the capital structure.
And the kind of rates, it'll be like 7, 8, 9, 10%, because it's a building, right? It's a high risk for them.
Yeah, but it's also we don't have the term sheet squared yet, but we're probably thinking it's going to be 8.5% money.
Not bad. And do they charge points at this high range of in the millions?
Yeah. Typically, there's 50 basis points, 75 basis points up front.
Okay.
But it's not terribly onerous.
Not like the hard money loans that we do. It's like 2 points.
Yeah.
And 12% interest. You're like, what the hell?
That's tough.
Yeah, so that's interesting. So these kind of stuff. So it's like a flip almost. Yeah, you kind of build a value in, and then you find a buyer who wants to park their money and get guaranteed cash flow, 6-7%, right?
Yeah, it's kind of a. I don't want to say. I guess merchant builder is a description, right? Where we come in and have relationships with retailers. Mm-hmm. We're able to find the sites, build the buildings, and then hold it for a period. But generally, we're not long-term holders, right? We're recycling, and we're delivering value to our investors, and the capital markets are such that there are investors looking in the secondary market for these types of assets.
Yeah, that makes sense. And it looks like, I'm trying to figure out from my, residential brain that, how would someone, let's say somebody buys it from you, there is no option to actually increase the value of the property till the term comes due and they increase the rents, right? Because they're all based on how much money they make, correct?
Yeah, I mean, a lot of the institutional investors have a longer term view, and so they're getting yield on their money, on their investment, but they're also getting capital appreciation, right? So if it's a 10-year lease, and the credit is such, they know that they could sell it, or they typically hold on to it for cash flow, and it's the fully triple net lease asset deals, don't require any property management necessarily, so it's almost clipping coupons. And so in addition to getting your annual yield, you're also looking at end of term capital appreciation on that asset as well.
How do you expect that capital appreciation if the rent is the same? Because
No, at the end of the term, say it's a 10-year lease and that tenant elects not to renew. If it's in a growth area, say Phoenix,
yeah,
that $30 rent might all of a sudden be $45 or $50 rent, or even higher in the future.
yeah, that's true. And then the cap rate could go down, which increases the value. So if they want to get out of it, people might be interested to accept a lower yield for a safer asset too, right? That's very interesting.
Right.
Yeah, man, that's cool. So for you personally, you don't do these kind of stuff. What do you buy personally? So if the listeners, most of our listeners, they don't have $6 million in cash. But they usually have like 50, 100 grand, and then they're like, hey, I don't have that kind of money, but I got 50 grand. Like, can I go buy uh the place where McDonald's rents, or like, how does that work?
What I've found is there are developers who will syndicate deals and raise money for individual deals. So it's a matter of networking with developers in your listeners' markets, getting to know who they are. $50,000 and $100,000 are meaningful slugs when you're a developer looking to build a single tenant net lease deal. There's plenty of room for people to participate there and do quite well. So I would say network, engage. Some groups have investment portals where you're an accredited investor and you're able to see deals, real live deals that are coming down the pike, and you have an opportunity to invest in them at that $50,000 or $100,000 level.
Yeah, that's true. And then they can expect similar returns. Do they do a profit split, or do they get like a debt structuring almost? You just get a flat rate.
Yeah, I think what you'll see is this general partner, limited partner, GPLP structure, and the limited partners generally get a preferred return on their money. Call it 8%. So they get the first 8%, and then there'll be a waterfall after that, depending upon how well the asset does. So you could go into it at 8%, and then you have 8% on your money. You'll have a pari passu return with the principal, the GP, and then these can be structured a host of different ways. But there's ways to boost that 8% to get you over 10 to maybe even 12%. on a strong performing asset.
Yeah. Okay. That sounds good. Let's talk about the new book you have out, man.
Yeah.
Can you talk about that? I know it's called Workshop.
It is. And I had this idea when I was working for a company called the Instant Group based in London. It's the Airbnb of flexible office space. We also built out office space for Fortune 100 clients like Amazon, GSK, Netflix, and a handful of others. And while the pandemic was happening, it really struck me, Vince, that this notion of work and office became decoupled. We as a world for 2.5 years worked from home for the most part. I mean, the majority of the working folks in the new collar economy, the keyboard economy, we didn't go into that office every single day, and we really developed some interesting muscle memory, right? We went from having work-life balance, which was elusive, to life-work balance, where now we weren't commuting. And at that time, I was living in Chicago. My commute to the office could be anywhere from, an hour to an hour and a half each way. So all of a sudden I had 3 hours back in my day. I could see my kids, I could work out, I could sleep late. And a lot of people realized during the pandemic that, at one point they thought they hated their job, but they actually realized they hated the commute. And they found that they were being much more productive working at home. They had more energy, they had more time. In fact, people probably worked more than they should have, because there were kind of limited boundaries between, people were just going back to their computers at 8, 9 o'clock at night. So workshop, what does that mean? Well, shop over 20 years ago was a noun, right? It was a physical place people went to. You went to a shop to spend money. And as technology evolved, we got to the point with cell phones and everything else, smartphones, that shop became a verb, right? It was a thing people did irrespective of place. And so we've seen this omni-channel retail expand. Now, it represents somewhere around 16% of total retail sales in the US. So total retail sales are about $3 trillion. And so that's about $480 billion of trade that's going on online. Work is going through that same metamorphosis where, if I would have called you 5 years ago and said, "Hey, Vince, I'm going to work and I'll meet you there later," work meant the office, right? And now since the pandemic, we've had this tectonic shift, and work and office have become decoupled. Work is something we do irrespective of place. Now, are offices dead? No. Just like retail stores aren't dead. It's just that consumers now have gained primacy, and they're going to use space with agency, autonomy, and optionality. And they want to be able to vote with their feet as to where they go and when they go, as opposed to what, a company. Today, we just saw Amazon come out and say January 1st, everyone's back 5 days a week. And guess what? It's blowing up in their face.
Oh, really? People are not liking that?
No, not at all.
Okay.
No, even when Amazon came out with their 3-day-a-week mandatory, the compliance was maybe 1.8 days a week. And it's a hollow threat. They have literally no way to police it. And they're actually, they're spending their time in the wrong place. So there's an awful lot happening here. We have this accelerating technology. We're entering into this next platform shift that's all about AI. The world is speeding up wildly. we have consumers who are spending, $500 billion online with retail. They've been doing it for 10 years, and now they've been voting with their wallets and how they spend their money. They now have the ability to vote with their feet and how they make their money. And I don't see people changing their behaviors that wildly going forward. So that doesn't mean that the office is dead. It just means that companies who have office space have to think about the space differently. You can't just build it and they will come. You can't think about the ribbon cutting like, hey, we built this office out, we cut the ribbon, our job's done. That doesn't work anymore. The ribbon cutting is actually when the work begins. And so companies have to depart from this whole Dilbert management approach, whereby if you're in the office and if you're sitting at your cubicle, you're being productive, right? That's this mindset, butts and seats is what they call it. And that's just not the case. We actually need leadership over management to help facilitate times when people are together. The office has to be experiential now. It can't just be this passive place. There has to be a purposeful presence as opposed to a passive attendance. So I think there's an awful lot of changes that are going on. There's a lot of space that is technically and functionally obsolete. There's going to be some cities that are going to have a lot of pain sorting through a lot of these assets. But there's sort of a brave new world that building owners and occupiers need to understand about consumer primacy.
Nice. Is that what do you talk about in the new collar economy? Is mostly like people don't want to go in, work 6 days a week, 9 to 5?
It's not that they don't want to spend time. It's just that in the new collar economy, and that's a term that was coined by Ginny Rometty, who was the former CEO of IBM. She talked about this world that we're in right now. These ideas. Vince, you and I are talking online, right? You could be working in the real estate industry. You could be working in the advertising, marketing industry. You could be a consultant. You could be a coder. You could be in tech. And let me ask you, why do you have to be in an office Monday through Friday, 9 to 5, when that's a vestige of the industrial era, right? I mean, we went to factories because that's where the inputs came in, and then there was a machine that we, pulled a lever, and then an output went out, whether we were making typewriters or whatever. And so for the knowledge economy that's generally operating on keyboards and Zoom calls and such, it doesn't really make sense for them to be in an office 9 to 5, Monday through Friday. And the way people have voted right now is that Tuesday, Wednesday, Thursday, it tends to be the times when people go to an office and have those face-to-face meetings and so forth. I think there's a lot more that companies can do to encourage participation beyond just mandating that people come in.
Yeah. So Joe, how can one listening, you've talked about how people don't want to, but how do we use this to our advantage? And you're still building buildings for, warehouses or Walgreens and stuff like that. So with this knowledge that we have, all these behavioral, things that you figured out, or economics, you call it in your book. So how do we use this information to, build our career, like in real estate? What would you say?
Have you thought about investing in real estate and taking advantage of all of those benefits without any of the work? That is something that AnVi Invest not only provides, but has been providing since its inception. With friends and family, we have built an empire and a system of a wealth generating tool that is giving us and our friends and family that leverage in their life to create true wealth. Go to onviinvest.com for more to see if you qualify. And thanks for listening.
I think you should be thinking about the interrelationship between residential, retail, and office. I think that's a sweet spot of live, work, play. And we're seeing really healthy ecosystems continuing to grow in and around the live, work, play. And I think if you want it to be edgy, you could look at some of the areas that are down in the cycle. I was looking at some office buildings in the Chicago Loop, for instance. One just traded for 80% less than what it sold for 5 years ago. Right. So,
Yeah, I saw that somewhere in the Midwest too, and I saw that in San Francisco as well.
So there's, I'm not saying, hey, run out and go buy an office building, but the enterprising real estate person really should think about some of the legends that came before us. And, guys like Sam Zell, they always say you make your money on the buy, right? And a guy like Sam Zell amassed one of the largest multifamily portfolios, office portfolios, and he always bought during the down cycle. So if you're able to have some dry powder, or get a group of people together, the down cycles are when you win, and being contrarian to everything else that's going on. So I would dig, I would find opportunities. Times like these are when you see assets going to, tax sales and auctions, and there's all sorts of really interesting ways to find space. Now, the key is to figure out what to do with it once you get it. But that's why you have a good team around you. You can come up with some good ideas.
So you're saying that if you're into building new structures, you would kind of mix residential living with like a one floor for office space, something like that, and then you would kind of like do that as a builder.
Well, that's a possibility, but you could certainly do, in a more dense area, do retail first floor and maybe residential above, or flexible office above. But more specifically, I would say focus in on trade areas that have live, work, and play in it. So, let's say you're in an area like the Fulton Market in Chicago. I'll just use that as an example for some of your listeners who've been to Chicago. It's just a mile west of the CBD of the Loop, and it's rich with really cool loft residential, really hip restaurants, great hotels, and then Google is there. McDonald's World Headquarters is in that area. So what I'm saying is, if you're looking for a solid bet and where to grow, you'd want to really focus on the healthy ecosystems that are live, work, play.
I see. So you're just talking about like a sub market where there's offices, but everything is kind of there. Like, so you would want to be associated with that area. That's what you're saying, right?
That's exactly right. Yep.
Oh, that is interesting, man. Yeah, I started buying some new builds last year and this year too. And we do get requests. We fully furnish them and rent it out to families who are moving around.
Cool.
And, we do get a lot of requests, like you're saying. It is interesting. I never thought about it, but subconsciously we've been having a bonus room, and it's kind of like an office play. So people are always like, "Oh, you got an office room? All right, cool. We'll come in. Because a lot of the guys, a lot of the girls, they got kids. They want to stay at home and work. So it is interesting that the culture is shifting, I would say, since the pandemic.
Yes. Yep. For sure.
Yeah. So what would you say, man? I don't want to keep you too long. For people, let's talk a little bit about economy, since you brought up the Feds. we're expecting maybe 25, maybe 50 basis points, but a lot of people don't know. Market's already priced in a lot of those things. So the mortgage rates are not going to be much affected tomorrow unless they do something crazy and the dot plots, they say like, oh, well, we're going to cut 3 points in the next year. Then it's going to be very good. So where do you see the economy is right now? And do you think it is a good time for people to get involved with real estate now? Because, I like to tell people it is never a good time. You're always going to be finding something. There's always a war going on. There's always an election. Something's going on in your state. So how would you tell those people? What would you recommend?
Well, I do think the black swan events like a global pandemic, no one can
Plan
guess,
for that. Yeah.
right? But what I would say is that there are always opportunities, and we still have a growing population. We still have a shifting population. So I'm sitting here in Florida where there's literally 1,200 people a day moving to the state, and so the Sun Belt, call it from the Carolinas down to Florida, over to Texas, up through Arizona, over to Orange County. You're seeing a tremendous amount of migration from the north to the south. Seeing a little bit of boomerang happening between people from New York who moved to Miami who are moving back to New York. But other than that, I would say, there's places like Daytona, Orlando, Jacksonville, which 10 years ago were sleepy little hamlets that have tens of thousands of housing starts that are happening. So with those housing starts, you have retail that follows, and then you have all sorts of other infrastructure and infill. So depending upon what your listeners are interested in, there's the geographic play that I would definitely focus on. It's something that my current development partners and I are looking at. In the Southeast, definitely the Carolinas down through Texas, and I think that's probably not going to change. And then in some markets on the West Coast in different cities, there will be some. I'll use the term grave dancing. It's what Sam Zell called himself, right? When the market is upside down and you have some cash to go in and buy low, that becomes a really good opportunity. So be on the lookout for those types of things. But otherwise, if you're, you don't want to bet against the American dream, which is housing. And we are still underhoused. And I think there's a tremendous amount of opportunity to be had there.
Yeah, man, that's well put. We started investing in Tennessee. You still think Tennessee is a good idea?
Well, Nashville, I was there a couple of weeks ago. It's just more cranes in the sky than I've seen in a long time in any city. Speaking of Amazon, they built 1 million square feet there, and the Nashville in particular is pretty attractive and in and around. I like parts of Eastern Tennessee as well. Knoxville, you've got the university. Great, sort of a great lifestyle area with the Smoky Mountains. And, again, people are looking for opportunities to move from urban jungles to, beautiful nature. And we're seeing the mountains of North Carolina, mountains of Tennessee, getting a lot of attraction. So there's definitely some great parts of Tennessee. Tennessee is very tax favorable as well. So if you're moving from California or Illinois, where I moved from, you're definitely looking at that.
Yeah, we're just outside Nashville. I like to look at a nice market and I buy outside of it for spillovers and greater appreciation. So,
really smart. Yeah.
we're looking at Georgia too. My family is we're from India, but we're settled in Georgia. So my parents and my sister, they're all north of Georgia. I don't know if you know Alpharetta area. It is.
Beautiful.
Yeah, very nice area. So yeah, people do like all that. I think you're right about the urban jungles too, the sceneries, and if you have kids and they like to play outside. Yeah, man, that's cool. Any other thing that you wanted me to ask, but I didn't? Anything that I missed? You think?
Yeah, I
Or you want
just
to talk about?
I think I spend a lot of time at the University of Florida. I'm on the
Mhm.
advisory board of the Bergstrom Real Estate Center, and we talk to the graduate students. And I just think the interdisciplinary discussion doesn't happen enough in real estate.
Mhm.
And so often we always just sort of pigeonhole ourselves as either retail people or residential or office or industrial. And definitely for the live work play, we should be thinking more and more about the interdisciplinary, because um, in places where there's limited daytime population, it's going to be really difficult to succeed in retail. And when you think about places that had 4 days a week before the pandemic of office workers during the day, and then now you only have 2 days a week, you can't. It's almost impossible to keep restaurants open and pharmacies open and sell some of the other services. So I do think there's something to be focused on to preserve and build healthy communities. And so, my prediction is that the office asset class is going to feel a lot more pain before it rebounds, and we're probably not going to see the worst of it until the end of 25, early 26.
And the office space, that's a tough. They're not going to recover, right? There's no way. Somebody's got to figure out something to do with that space, right? Like your whole book is about how people probably don't want to go to work 5 days a week, right? So those buildings are going to have a bad time, right?
There's going to be for the right type of space, really relevant. I use the example of One Vanderbilt in New York City, opposite coast from you, but it's a brand new building that's right next to Grand Central Station, and it's completely full at rates approaching $300 a square foot. So it's not that people don't want to go to an office. It's just that it has to be relevant and worth it. And just to commute 2-3 hours a day just to sit in a cubicle and be on Zoom calls is really uninspiring.
Yeah,
But
that is true.
yeah, but if you can, if you know that you're coming in and I'm going to see Vince and I'm going to see 20 other of my colleagues that are on our team, and we have 2 or 3 days planned, we're going to go, think about what's next, how we're going to tackle the next 3 years and whatnot, then that becomes really energizing, doesn't it? But just showing up to show up is missing the point. We need to curate these experiences. I'm not saying that employees, are like kindergartners and you have to keep them active, but there has to be a purpose, and it can't just be this passive catch-all where people show up and you pretend like you're managing them and they pretend like they're working. Doesn't work that way.
Yeah, that is interesting. I think you have a good point, Joe, about the ecosystem, and you go to work Tuesday, Wednesday, Thursday, and you're meeting Joe and your the other co-workers, and you're like, let's go down. There's a new coffee shop, whatever. But if you're driving 4 hours a day and it's in the middle of nowhere for a 2-minute Zoom call, and you're just like, dude, people are that building is not going to do well. So interesting. So you're saying you should try to, when you do future investments, think of these things, look at demographics, see where the migration is, see where people want to hang out, and try to invest in those pockets is what you're saying. Yeah.
I think that's a good idea. Yep,
Yeah.
that's a winning formula for
Yeah. And
sure.
if people want to get educated on these things, I know your book is good. Do you recommend any other books for people to get up to speed so they can get in the mindset of these things to invest and not only think of W-2 jobs?
Yeah, one of the classics just to learn about development is a, the biography of Trammell Crow, the builder,
Okay.
and I recommend that.
How do you spell it? Travil?
Trammel
Crow.
Crow. Yeah, he was. There's still the Trammell Crow company still exists. Uh, Part of it was sold to CBRE, and he was a master builder in Dallas and built uh, all sorts of office buildings and hotels and a number of different things. But it tells the story. This isn't this isn't a business that's for the faint of heart, right? It's tough. There's setbacks. There's challenges. There's as much as you'd like to control everything, there's so much that's uncontrollable. So anyway, I find that to be a really good story. I think that from a LinkedIn perspective, if people are interested in the future of work, what's happening with research, there's a brilliant economist out of Stanford named Nick Bloom, Bloom. He's a fantastic follow. Just a clear blue light thinker, has tremendous research chops, and is talking to a lot of people. So I put a lot of value in what he says and what he researches.
Nice, man. I was in. I just got back from Spain and Greece, and was in Barcelona for a week. And I don't know if you know this guy, Anthony Gaudi. I think his name is. Dude, that guy is crazy. He was just building some crazy stuff, architecture-wise. It's just insane.
Did you go to the Sagrada Familia?
Yeah, they're still building it. I don't know how many hundreds of years they're building it, but they're still building it. It looks crazy.
Barcelona is one of the great cities in the world. I'd love that. Gaudi it's just so trippy and interesting, and I love what architecture can do, and even just the urban architecture in Barcelona is just fabulous. So good for you.
Yeah, he was always. We did a guided tour, and the local, she was telling us how he would always. He was Christian. I was raised Christian too, so my family got a kick out of it. That he would secretly put some Christian stuff in the building, and then the people who paid them were like, "What the hell, man? Like, we didn't say to you to do this." But he's like, "This is part of my style." They're like, "What the hell?" So it was just hilarious to see.
Well, that sounds like a great trip. That's fantastic.
Well, thanks, Joe. Thanks for coming on the show. Any last words, Joe?
Yeah, Vince, thank you. I really appreciate it. If any listeners are interested, my website is joebrady.ai, and the book Workshop is available on Amazon. If you go to the website, there's links to Amazon, Barnes & Noble, and others, and just some other articles and whatnot. My LinkedIn is on there. If you want to follow and get some insights, and love to hear from your listeners as well.
Yeah, we'll put all the links on there. Are you active on IG at all?
I am.
Okay.
It's probably more of traveling. I mean, do you recommend it? Are you following? You think Instagram's good for business?
I would definitely say if you want to hit the younger population, and I will recommend it.
Well, I just got back from Chile and Peru, where I was speaking at WorkTech in Santiago and Lima, and my wife and I, over Labor Day weekend, went to Machu Picchu. So I've got some really cool shots of Machu Picchu, and the highest Irish pub in the world at 11,100 feet in a little town called Cusco.
Cusco, what country is Machu Picchu in?
It's in Peru.
Peru, nice, cool.
Yeah, in the Andes. It's fabulous. Yeah, highly recommend.
Is that in the south? Of South America?
South America. Yep. Really on the Pacific side, on the western side of South America. Yeah, and Chile is fabulous as well. So very safe, beautiful people, friendly. With U.S. dollar, very economical. The food in Peru just blew me away. 3 of the top 20 restaurants in the world are in Lima, Peru.
Oh, wow. I did not know that.
Yeah.
I love food. So I might, we just got back from Europe. I'll be heading to Mexico a couple of months for a wedding, best friend of mine. And I've been picking up Spanish. So, I pick up Spanish pretty good. I mean, I got all of South America except Brazil to just go.
There you go. It's all yours.
So that's my plan. So maybe I'll swing by Peru or Colombia.
Yeah, Colombia's doing quite well too. I was talking to some friends that just were there. So awesome.
Well, thanks, Joe. Have a good night. I don't want to keep you any longer, and then maybe we'll follow up in a year to see what you're doing.
I'd love that.
Yeah,
really appreciate it. Take care.
Yeah, see you, Joe. Bye.
I don't know about you, but I definitely like to see 5-star reviews on any service or any product before I purchase. Please take a second to leave us a 5-star review, whether you're listening to it on Apple, iTunes, or Spotify, or whatever platform. Take a second, goes a long way, helps us a lot to grow the channel, and thanks for listening.